Blind Squirrel Macro the Pod, our usual companion to the weekly newsletter. Squirrel coming to you on the morning of Monday, December the 2nd, Melbourne time. Quick reminder to make sure that you get the show notes for charts and links, and if you don't have them, fix that right now by signing up for free at blindsquirrelmacro.com. Before we start, everything in this podcast is for educational and entertainment purposes only. It's categorically not investment advice. Please, before making any investment decisions, for heaven's sakes, don't listen to a cartoon squirrel. Talk to a financial advisor. Now, at risk of making a statement of the bleeding obvious, it has been yet another extraordinary year for US equities. November closed at a fresh all-time high for the S&P 500, and the fervent post-election embrace of risk left this rodent almost surprised that the monthly candle was only the 7th largest percentage move for the SPOOs since the COVID lows. We got our Santa rally with bells on. But is the old boy now out over his skis? What's even more remarkable is that this move was pulled off notwithstanding a negative contribution from most of the large cap tech giants that have dominated index returns for the past 2 years. Investors are instead reaching for financials and consumer cyclical stocks, as if a rollover in the business cycle has been permanently deferred. The Wall Street Journal's Recession Barometer, which tracks consensus probability of the US entering a recession in the next 12 months, has now been cut in half since early 2023 and is now well below a 30% probability. To be fair, who cares? Wall Street's recent track record in calling US recessions has been utterly abysmal. I should say that the squirrel is also guilty of resolutely being with that 60% plus doom consensus at the end of 22, beginning of 23. However, I am gradually finding myself once again in the concerned camp when it comes to the economy. If you didn't catch Adam Taggart's excellent interview with Bloomberg's economist Anna Wong on Thoughtful Money at the end of last week, do try to look it up. There's a link to the show in the notes. Anna is concerned about the disconnect between optimism in financial markets and what she sees as a potential weakening trend in the labour market. A softness which may see a surge in unemployment before any of the pro-growth policies of the new administration can be implemented and can take effect. I find myself rather nodding vigorously as I watched it. Indeed, these animal spirits are not to be found in all financial asset classes. For example, this shiny recession-free future memo is yet to be received by commodity markets. Bloomberg Commodity Index futures are still firmly in a downtrend, with large speculators barely beginning to cover their large short positions, which are mainly still focused in the energies and the grain complex if you drill down into the individual markets. And there is one traditionally cyclical sector that does appear to be giving signals of a negative shift in economic conditions. I speak, of course, of semiconductors. Nvidia's heroic 179% year-to-date move accounts for an enormous 53% of the somewhat lackluster 12.7%, at least relative to the market, advanced by SOX, the iShares Semiconductor ETF this year. Even Jensen Huang's distant cousin and AI darling competitor, Lisa Su over at AMD, is down on the year. Nevertheless, promises of tax cuts, deregulation, and a general Trump trade feel-good factor is seeing a reanimation of the rotation trade into small caps versus the tech giants of the Nasdaq that we saw play out following that horrendous debate at the beginning of the summer. Your favourite rodent is not saying that this outperformance cannot charge onwards in the short term, particularly if fueled by strong seasonal effects and some interesting dealer positioning in the Russell and S&P option complex. Now, the next bit you might definitely need the notes for. I've included an image which highlights two things. One, some very significant open interest in the SPX December 19th 60/50 calls. This happens to be the call strike of the famous JP Morgan whale trade, a put spread collar embedded within its jumbo hedged equity mutual fund. I refer to my good pal Kevin Muir as the Captain Ahab of this particular large marine mammal. He has written on the topic multiple times over the years. He also discussed the trade this weekend with Imran Lakha on the Market Huddle. The 5-second summary is that hedging activity around that large open 60-50 call position, where dealers are long options from JP Morgan and short the underlying index futures, could create a significant overhead resistance for the S&P 500 over the next 2 to 3 weeks. This is because the dealers need to increase their short as the market rises. The other thing I highlight is the jumbo open interest in out-of-the-money call options on Russell futures and the IWM, the Russell ETF, again for the regular December expiry. In this case, the dealers are short those call options and need to add to long underlying equity hedges as the market rises. So that's a move that could get dynamic very fast. As I set out at the beginning of the month in Zombie Beta, if you do want to chase some small caps, by all means go for it, but just be careful to know precisely what you own. For what it's worth, in that report, the Squirrel had a forensic look under the hood of the Russell 2000 index and concluded that it is basically a random ragbag of economically unrepresentative, stock-based compensation incinerating shitcodes with an inverse Darwinian selection bias. To be crystal clear, while the Squirrel is no fan of the Russell 2000 futures or of the IWM as a long-term buy and hold strategy, I am in no way suggesting that it would be a good idea for readers to place themselves in front of this potential runaway train into year-end. Potential small cap outperformance into Christmas is one thing, but moves in other parts of the capital markets have this rodent's whiskers twitching even more violently. In a polarized world in which certain stocks have adopted a cult-like status with their tickers being cheered on like a favorite sports team, I keep the composition of the Squirrel's garbage portfolio a fairly closely guarded secret. Regular listeners will have a reasonably good idea of the types of names that I see as good candidates for short positions, as and when the time finally comes for what Chase Taylor calls the financial justice warriors. I give thanks to the market gods that I'm not short any of the garbage portfolio currently, as they just put in a 30% rip up in November and are now within reach, just less than 4%, of the S&P 500's impressive move for the year. I also guess that enough column inches and podcast hours have already been dedicated to the topic of the insanity machine that is Mike Saylor at MicroStrategy's attempt to corner the Bitcoin market. Instead, I just want to quietly remind you that this rodent's distant cousin, an unfortunate MAGA avatar, Peanut the Squirrel's altcoin, #PNUT, continues to have a market cap of north of $1 billion. I am clearly in the wrong game. And let's not start on the Hawk Tuah coin, which is due to launch on the 4th of December. Like the Murphys, I'm not bitter. Well, maybe just a little bit. Short pod this week, as this week's section 2 contained an extended review for paid subscribers of the current Acorn portfolio. Shouldn't you be getting a bit of that? Anyway, get more Santa rallying rodent at blindsquirrelmacro.com. You can also find me on Twitter at SquirrelMacro and Blue Sky at Blind Squirrel. Thanks again for your ear. Do please spread the word. Squirrel out.